Two of the major oil companies, ExxonMobil and Chevron, were out with their latest results today. And as you might expect, low oil prices spelled trouble. Exxon's profit fell more than 60%, its lowest quarterly level since 1999. But to put it in context, revenue was still nearly $49 billion. Remember, that is for the quarter, folks. As for Chevron, profits turned into a loss, and it was more than Wall Street expected. In the end, both companies were relatively flat in today's trade. Jackie DeAngelis goes deeper into the numbers.
Big energy reporting this week, and by all accounts, it was a tough quarter. Exxon managed to beat expectations with 43 cents earnings per share, but that profit was achieved by slashing costs to offset plunging crude prices in the first quarter. The company's capital expenditures dropped by 33% year over year, showing drastic measures were necessary to survive a quarter where oil fell to almost $26 a barrel.
It's very hard to see this thing outperforming. On its valuation, it's already pricing in oil at about 75 bucks a barrel. So, plenty of oil stocks are pricing in oil in the 60s, a lot lower than what Exxon's pricing in.
If you look at the details, ExxonMobil pulled out a profit because of the refining and other types of downstream profits that offset that were still losses in upstream. So, when you look at everything, these lower prices are providing excellent margins for refineries and for the chemical units of these integrated companies.
Meantime, Chevron outright missed expectations, reporting a net loss of 39 cents a share compared to a net profit of 137 in the same quarter last year. Chevron CEO John Watson said in a press release that controlling spending and getting key projects under construction would boost revenue. And with oil prices up nearly 20% in the last month, some analysts are hopeful for the future, but others are not.
We're anticipating a continuation of an oil recovery into the 60s by the end of the year, probably 70s next year. But in the case of these two names, because of how well they held up during the meltdown, they're already pricing in essentially all of the recovery in the commodity that we can envision.
Unless we just see global growth go to nothing, then eventually we tighten up. That might be a year or two down the road, but we're going to have to resume production growth globally longer term.
Recall also that earlier this week, Exxon lost its AAA credit rating from Standard & Poor's, a credit downgrade, another blow to the company's reputation. For Nightly Business Report, I'm Jackie DeAngelis.